Welcome to Mortgage Markets and More. I am your host, Peter D'Angelo at Rate. As always, welcome to Friday, everybody. We're halfway through the month of December. I hope you've gotten all of your holiday shopping taken care of, especially if you're ordering online, because I know we're running into the danger zone, the delivery danger zone. So I've got your mortgage rate update and real estate update and some very important things to know about if you have plans and you're making preparations to purchase come the new year. We're going to start off with where mortgage rates currently are. We're going to talk about our bonds. We're going to talk about what made this environment what it is currently, why it may have some impact in the short term here as we close out the year. And then we're going to take a look at what things look like going into 2025, in particular for the latter half of the show today. So let's get right into it. These are the average mortgage rates as of recording this podcast, the Thursday before its release, according to Mortgage News Daily survey of the average mortgage rates in the country right now. The 30-year fixed rate mortgage is averaging 6.8%. That's down slightly from last week. The 15-year fixed rate mortgage is averaging 6.05%. The 30-year jumbo fixed rate mortgage is averaging 7.03%. The 30-year FHA mortgage is averaging 6.16%. And the 7/6 SOFR adjustable rate mortgage is averaging 6.65%. Across the board, some slight improvement, although it was a little bit better earlier this week, and things have gotten a little bit deteriorated, let's say. And we're seeing the interest rates sneak up a little bit as we're closing out this middle week of December. The bond market set the stage last week, and we talked about that a little bit. I said, this could be moving things in a different direction. The bond market this week, up quite a bit now. Starting off with the 10-year Treasury yield is at 4.314%. That's up slightly from 4.217% the week prior. The 5-year Treasury yield is at 4.16%, and the 2-year Treasury yield is at 4.17%. And that's nearly flat compared to last week. So we're seeing the 5-year and the 10-year going up a bit, and that 2-year is staying pretty flat. And let's talk about why this market is moving in that direction, and we're starting to see what we call interest rate reprices, which means that interest rates are changing, and they're changing currently for the worse in the sense that interest rates are going up a little bit. Here are some of the things that happened over the past week. This week, as recently as yesterday, we got the Consumer Price Index. The Consumer Price Index, the CPI, is an inflation reading. It lets us know what inflation is looking like. Well, that came in at expectation. And the expectation was that it was going to go up a bit. Came in at 0.3% up month over month. That meets expectation. That's up 0.1% from the prior month's reading. The year-over-year Consumer Price Index came in at 2.7%. Previously, that was at 2.6%, reflecting some slight inflationary pressures in the economy currently. The core CPI, and again, that is taking into account all of the things in the market that people are spending money on and removing the volatile elements like food and energy, that came in at 0.3% month over month and 3.3% year over year. The CPI reading in totality was at expectation. So no great shakes there, and that was kind of celebrated by the market. Things were remaining relatively normal up to that point. Another element was the federal budget surplus that we saw for the month. The expectation was actually that there was going to be billions of dollars in deficit. If you recall, when we looked at it last time, there was a $350 billion deficit, $314 billion deficit last month when we talked about that. The expectation was to go along that trend and have another $350 billion deficit. Well, that actually landed in a surplus. So the budget had a $360.8 billion surplus as of this past month's reading. So we get the report now in December. This is for November. The labor market, let's talk about that. We talked about the CPI. That's inflation. Important for the Fed. They are meeting next week. These are the pieces of data they're going to look at when they're setting their monetary policy and making their interest rate decision. So we have the inflation component taken care of. Unfortunately, the Fed's preferred inflation gauge, the PCE, the personal consumption expenditure, that gets released after their meeting next week. I will have that information to report out to you, but the Federal Reserve will not have that reading. They're going to be looking more closely at the CPI this go around. But other than inflation, we know that the Fed is very intently fixated on what does the labor market look like. And here's what we have over the past week by way of that data. The initial jobless claims, which we get weekly, that came in at 242,000 jobs. That's up from the expectation of 220,000 jobs for the initial jobless claim. And it's also up from the previous reading of 224,000 jobs. The employment report did show 227,000 jobs added last Friday, and the expectation there was 214,000. A little bit of a mixed bag so far. So there's continued resilience in the labor market. The unemployment rate remaining at 4.2%. That's in line with the expectations, but that's slightly up from the prior reading. It did sink down to 4.1% last month. Wage growth is another important element. This is the data to show us how much more money people are making when we look at the numbers month over month. And the wage growth, hourly wages year over year, increased 4%. So if we've got inflation running at 2.7% and wages running at 4%, that means the American consumer and the American citizens doing a little bit better than what the inflationary pressures and the price changes for the goods and services they're paying for are currently yielding. So overall, kind of a mixed bag. Stronger job market, that's good news. Maybe that will set a stage here for the Fed to not cut their benchmark interest rate in their December meeting this month. As I mentioned before, my opinion is I don't see a case for the Feds to cut the rate. So if the Federal Reserve does not cut their interest rate, that will be not in harmony with what the market is expecting. If that is the case, expect volatility, expect rates to move in a direction, most likely up if that is the case. Otherwise, things could kind of remain status quo and stay a little bit flat. The producer price index was just released today, so I did delay the production of this episode so I could report out on that for you. The producer price index is how much it's costing for the goods that are eventually sold to the consumer, and that showed that the monthly PPI, producer price index, rose 0.4%. That's up from the expectation of 0.2% growth, and also the prior reading was 0.2%. So that means there are inflationary pressures behind the scenes before it reaches the American consumer right now based on this report. The core PPI, again, taking out the volatile elements like food and energy, that growth slowed to 0.1% growth month over month, which is slightly better than the expectation of 0.2% growth. And also, the prior reading was 0.3% growth. So that's a cooler number for the core, but the headline that takes into account absolutely everything, including the volatile elements, was higher than what was expected. The year-over-year increase was at 3%. Prior, it was 2.6%. So if we can see core PPI stabilize and see some price stability on that end, maybe that can start to ease inflationary pressures. But where we're at right now is we still are seeing inflation rear its ugly head. As long as inflation is still something to manage, you can expect volatility and likely a higher interest rate environment. One other part I wanted to mention was the consumer metrics, particularly the consumer credit card debt. We talked about this last month. This was something that I started to include in the episodes because it gives you a look at what the American consumer is spending and how much their extension of credit is looking like. And we get this reading. The consumer credit, the October reading, it's 2 months away, 2 months delayed. The October reading surged to $19.2 billion. So it means $19.2 billion of credit card debt that's currently outstanding. The forecast was half of that. Well, a little more than half of that, $10 billion. And then the prior reading was $3.2 billion. Well, now I can tell you that we don't necessarily have all of the retail sales data yet for this holiday season, but if that consumer credit card debt's any indication, it's going to indicate a very strong retail sales then. We're talking about nearly $20 billion of extension of credit that the American consumer has taken out, very likely because of the seasonality and doing their shopping for the holiday season. The overall market sentiment is mixed right now. As we saw, inflation, a little bit of a mixed bag between the producer price index and the consumer price index. The labor market, strong, but also a little bit weak. The expectation was a little lower for the jobless claims. That came in a little higher. So things are shifting, but not enough or in no way for us to establish a trend that is anything valuable for us to forecast accordingly. Speaking of forecasting, that's what I wanted to spend our time today talking about. For the rest of this episode, we're going to be talking about outlook and what's ahead here for 2025. Last week, we talked about surveys of forecasts of where interest rates are going to be going, particularly the 30-year fixed rate mortgage, and what that's going to look like as we go into 2025. We kind of pulled all that together to get a picture of what it looks like, and it kind of seems that the consensus is flat. So I wanted to highlight yet again today some more information. Some of this was covered last week on the episode. Some of this was just pulled from data from November forecasts that I was able to find online through various sources being Fannie Mae, Mortgage Bankers Association, and also Wells Fargo, the bank, gave out their guidance on interest rates. They each gave out their guidance for each quarter of the year, starting with the fourth quarter, the one we're in and about to wrap up here in 2024, and moving forward all the way to the fourth quarter of 2025. Here's what that looks like. This is the average. So I'm trying to get a consensus among their different numbers. Looking and drilling down into those numbers, there wasn't much variety. Maybe a little more optimism or a little more pessimism based on who was reporting out on it. But what we look at right now is a 2024, right now, an expectation that interest rates will land at 6.67%. We're averaging 6.8 today. We'll see if the Fed cuts rates. If the Fed cuts rates, it makes a better environment for interest rates to go down and meet that forecasted expectation. First quarter of 2025, the consensus is somewhere around 6.58% as an average 30-year rate. 2025 quarter two, this is the bulk of the spring market heading into the summer, 6.45%. So a little bit of a trend downward. The third quarter of 2025, expecting 6.32%, and the fourth quarter of 2025, expecting 6.33%. So the overall trajectory is down, and then you kind of see it slowly settle as you get closer to the end of the year. All of this is due to the fact that anyone who's going to forecast mortgage rates out into next year, let alone over the next couple of weeks, we try and do that on a weekly basis together, and that's tough. We're doing pretty good, but it's tough to do, especially because there's so many things that influence mortgage rates. As it stands right now, the market fundamentals and what's available to us and seeing in the operation in the market, I'm in agreement with all these averages. I think that probably 6.5%, if we take the whole year and average it out, is probably where we're going to land next year. That's only 0.3% lower than where interest rates are currently averaging. So, and for context, we're just above the middle of the road right now with our average mortgage rates. So if we look back at the past year and do a survey of mortgage rates from this point going back to December 13th, 2024, we're just a little bit higher than what the full spectrum of interest rates have been over these 52 weeks. So I think it stands to reason that we'll see interest rates come down a little bit, but I do not believe that we're going to see interest rates drop. It's just, I don't see it there. The only thing, and I say this every week, the only thing that could create that interest rate environment is if something comes out of left field, something that we can't anticipate, something that is going to have an impact on the markets, good or bad, that will create a lower interest rate environment. But also, the same could be said about interest rate increases, with interest rates possibly going up. Things like inflation staying really sticky if the Federal Reserve needs to hold off on their interest rate cuts. Things like that could create a higher interest rate environment, higher than the 6.5 range that it looks like the consensus is for 2025. That being said, I'm not going to just give you that information. I want to give you a little bit of a tool. We talked, and I would encourage you to go back to past episodes to check this out. We talked about discount points. As a quick refresher, you can pay a premium at closing for a lower interest rate than what is current market. So let's say it's 6.8% right now. Well, when you move forward in your mortgage application process and your mortgage advisor is going to lock in your interest rate, you can have that conversation and say, well, 6.8 is what's available right now, but I like my rate to be a little bit lower. How much would it cost to have 6.5%? They would look, this changes on the daily. So how much your money will go by way of interest rate relief with discount points depends on the market that day and also how long your interest rate lock is. So taking all that into consideration, it's still part of the conversation you can have. I will tell you this, dollar for dollar, the money that you spend on discount points will provide you with more interest rate relief and a lower monthly payment. Particularly, let's focus on the lower monthly payment part. Dollar for dollar, the money you spend on the discount point will provide you a lower monthly payment than it would by spending that same amount of money and putting more toward your down payment. The pros and cons of this. Number one, it's one and done with discount points. That is collected at closing. You close on your mortgage. That's your interest rate. So the con is one and done. There's no way to get that money back if, let's say, there's an opportunity to refinance 6 months from now. You're going to have to refinance at whatever rate that is. Any money you spent on a discount point cannot be recaptured. Secondly, another pro, like I said, dollar for dollar, you get more relief and you don't have to worry about that rate changing. If you do temporary buy downs like we did a deep dive into a couple weeks ago, that's good, but at the end of your term of that temporary buy down, you've got to make sure you're prepared for what that monthly payment is. A permanent discount point, paying right now for that, will yield you a much better interest rate and a stable payment for your mortgage term. If we're seeing these forecasts for mortgage rates being what they are, may be the prudent decision. The con is it costs additional money. Your closing costs will be higher if you're going to leverage discount points. So bear that in mind. For our Did You Know section today, we are going to do a full review of loan limits. I know, it's a little dry, but I'm going to be excited about it because interest rates being what they are, we've still seen resilience in the real estate market. We are still seeing real estate values continue to appreciate at now what I can say is an incredible pace. Not necessarily if we look at it in the context of year over year, it's still like very good property appreciation. But when we take into account the fact that home values went up so much from pre-pandemic to post-pandemic levels, and that we're still seeing property appreciation, the last NAR report we went through, in some regions, 7 to 8% appreciation year over year. Here in North Jersey, we're tickling that. We're, anywhere, it depends on the month's reading, anywhere from 5.5% up to 7.5%, 8%, depends on the market and how desirable the market is. So taking all that into consideration, we're looking at this right now. Well, on the lending side, we have limits. So Fannie Mae, Freddie Mac, under the umbrella of the Federal Housing Finance Agency, have a maximum amount of a loan that they can lend. If you go above these limits, you enter into a loan program called Jumbo. And that means it's loans that are provided by banks that are not sold off to Fannie Mae and Freddie Mac. We'll get to that on a later episode. But for right now, Fannie Mae and Freddie Mac set up the guidelines for lending. Part of their guidance under the supervision of the Federal Housing Finance Agency is to give us these loan limits. So we're going to go through the loan limits. We're going to start off conventional. Then we're going to talk about the FHA because those are different. The Federal Housing Administration loans, those are government loans. Those have different limits. And then there's also VA loan limits. And each one of them breaks down. So we're going to kick things off first with the conventional loan limits for 2025. Single unit properties, single family homes. The limit is now $806,500. That is up from $766,550 in 2024. So that's quite a bit of an increase. That means if you're purchasing a home for, let's just say $800,000 and you're putting 5% down, you're within that limit. 2-unit properties, this is multifamily, that limit now increases because it's a bigger property. Makes sense. That's $1,032,650. 3-unit properties steps up to $1.248 million, roughly. 4-unit properties go up to $1.551 million as your maximum loan amount, so you're falling within these loan limits. High balance is another component. So if you happen to live in a high-cost area, there are areas of the country that are designated as high cost. For the listeners who are here in New Jersey, New York metro area, it's very likely you live in a high-cost county, so these loan limits will apply to you if you're purchasing in those markets. The high balance limit is $1.209 million. So that means if you're buying a primary residence, single family, you could be, or even, second home investment property, this still works. It's single family. That's the important part. You can have a loan up to 1.2 million and change. 2-unit properties, 1.548 million and change. 3-unit properties, 1.872 million and change. And 4-unit properties, $2.326 million and change is the maximum loan that you can get. Anything above that would be jumbo. However, given those amounts, that's covering our bases pretty well here. Now let's talk about the FHA. So FHA is exclusively for primary residence. I believe you could do second homes with FHAs, but don't quote me on that. I'm going to come back next episode and correct myself. So standard limits for FHA financing in the country right now have been changed to $524,000, $524,225, and that's up from $498,257,000 in 2024. 2-unit properties, $671,200. 3-unit properties, $811,275. And 4-unit properties, $1,008,000. So that's your FHA loan limits, and they do have high cost limits for those parts of the country that are designated as high cost as well. Single family home up to $1.2 million and change. 2-unit properties, $1.548 million. 3-unit properties, $1.872 million. And 4-unit properties, $2.326 million as your maximum loan amount. So for most of the counties in New Jersey, because it does go by county, you can get FHA financing up to $1.2 million for a primary residence. That's pretty high, and that is accommodating us now because of the incredible increase in home values over the past 3-4 years. The VA loan limits, no limits apply to the entitlement for the VA loans. So if you are a veteran and you are seeking financing, you have your VA entitlement, which does allow you financing for a purchase of a primary residence with 0% money down. So these limits don't affect the entitlement amount. However, borrowers with partial entitlement, this is when you've maybe purchased a primary residence and now you need to move and you need to purchase a new single family or multifamily primary residence outside of the area you currently own a home. You don't necessarily need to refinance that mortgage, but it will have impacts on what your next purchase is going to look like and very likely will require you to have some element of down payment unless it's a much smaller price point. That limit for single unit properties is $806,500. In high cost areas, $1.209 million and some change. So you're talking about $1.2 million, kind of mirroring what we're looking at for the FHA loans. So the key points to take away here. We have loan limits reflecting 5.21% increases in the U.S., and that helps to accommodate the rise in home values and expand the access to financing for borrowers. And these limits take effect January 1 of 2025. So these are now fully published. I was toying around with the idea of sharing them earlier, but I was like, you know what? Let's wait until we have all of the information so I could provide you with 100% of what these loan limits look like for 2025. that's it for me today. I hope you found this helpful and useful. There was a lot we went through, but I really do hope that this can help you. If you're a real estate professional, give you useful information when talking with your clients. Feel free to share the show with your clients if they'd like to stay in the know and stay up to date. If you are a prospective home buyer or a homeowner toying around with the idea of selling and buying, or maybe not a homeowner and you're a first-time home buyer, and part of your New Year's resolution is to prepare yourself to buy a home, I hope you've been finding this information useful and helpful. I will be back next week. It's a big week next week. We've got the Fed meeting and making their announcement about monetary policy. I'm excited to see what that looks like, and I will report out very thoroughly what we get from next week's Fed meeting, as well as that personal consumption expenditure, because I would expect between the Fed and the PCE coming out, we're going to see some type of market shifting or movement ahead of the Christmas holiday the following week, as well as Hanukkah and the other holidays, which all start the week following. In the meantime, please like, share, subscribe. If you have questions or anything you'd like me to cover on the show, or deep dive into anything I may have touched upon, reach out to me. My email address is peter.d'angelo@rate.com. Feel free to send me an email. You can find me on socials, shoot me a message. Would love your feedback. In the meantime, have an awesome weekend and take good care.